For more on this, we want to bring in former Cleveland Fed President Loretta Mester. She's a senior scholar at Princeton. She's an adjunct professor at UPenn's Wharton School and a CNBC contributor. And Loretta, let's talk about what Steve was just laying out. In his survey, 87% said they will cut, 45% said they should. Where do you come down on both of those questions?
So I think they definitely will cut. I mean, they signaled that quite clearly in President Williams' speech, the New York Fed president, before the meeting. So I think they're going to follow through with that last cut. I do hope that they signal that, you know, they think the economy has gotten to a place where policy is in a good place and they are going to slow down the cuts, because I am more concerned about the inflation risk, the stickiness. But you know what gets attention are the things changing, and we've seen this weakening or softening in the jobs market. Yeah. So that gets the attention for a while. I do think we'll get weaker data, because I think we're going to see government jobs in the new data being weak, because that's the end of the furlough or the delayed firing of the government employees. So again, we're going to see some weak reports on the labor market, but it's still in balance in terms of supply and demand.
You said this last cut, so you don't think they're going to be cutting again come January or beyond?
I hope they pause for a while and really assess where the economy is going. And I hope that at the press conference we get a good sense of where they're seeing the economy going. I think this counting, dissents and then thinking about, well, do they have enough to cut again or not, doesn't really tell us how they're thinking about what the outlook for the economy is, and that should be driving their policy decisions.
It's interesting, though, that what you say, we pay attention to the thing that's changing the most, and the jobs picture is what's changing the most.
Right.
That's an argument for cutting.
No, it's not, in the sense of you really need to look at where inflation is. Inflation is not back to 2%.
Right.
So they're going to need to keep policy somewhat restrictive if they are going to put downward pressure on inflation. And right now, inflation is pretty well above the goal. And it's not just all tariff-driven. There's stickiness in the non-tariff-affected parts of inflation. So they're getting very close to neutral. And in certain of the policymakers have said they think they're already at neutral. So continuing cutting is really moving policy into accommodation, not just moving it back to neutral or a little restrictive.
We've had some conversations around this morning. Mike Wilson was here. He's got a pretty strong outlook for the markets next year. I think he was saying 6,900 maybe, or 7,900 maybe, for where he expects the market to be next year at this time. But he said the biggest risk is inflation, that if inflation comes back and the Fed then decides to raise rates as a result of going after it, that is the biggest risk to continuing to see this. Do you think more than pause, the Fed should actually raise rates at some point to attack this inflationary problem?
So not at this point, because they have to balance both parts of the mandate. So we have seen the softening in the labor market, and they've taken out some insurance cuts. They'll do it again this week. And I think that's appropriate. But they cannot continue to do that and move policy into an accommodative stance, like blow through neutral. And then we will have an inflation problem because we won't have restrictive policy putting downward. So I think they're doing a good job of trying to balance those risks. But at some point, they're going to have to take on the fact that they need to have somewhat restrictive monetary policy if inflation is going to move back down to 2%. And even in their own forecast from September, it was going to take till 2028 to get back to 2%. So I think, they see the problem. The question is, how do they execute policy so they remain at a good place to address potential risks manifesting themselves differently in the labor market than they're expecting, versus making sure that they're going to put policy in a place to get inflation back to 2%, because it's been above 2%.
It has.
Right? Almost 5 years, and that's a problem.
We have a lot of conversations we have today and every day about artificial intelligence, how corporations are incorporating AI into their businesses, and then kind of waiting for the efficiencies that come with that, the productivity efficiencies that are expected to come with that. How do you measure that when you were at the Fed? How do they look at that?
Right. So you have to take into account there's certain things in the economy that are maybe trending in a way, right? Productivity has been going up. So they're going to take that on board and say, okay, we're not certain about it, but we have to forecast that we think that we're going to get productivity gains. That's what I want to hear from the Fed. How are they thinking about that? How are they building that into their forecast for the economy? And then once we kind of have a view of their outlook, and the risks around that, we can then assess, okay, is the data coming in and telling us that their outlook is right? Or is the data coming in and saying, we have this part of it wrong, they're going to have to adjust that. And that's what if you're doing forecasting, that's the proper way to do it. You have an idea of where the economy may be going. There's risks around that, of course. You have some alternative scenarios that you think maybe manifest themselves. And then you're ready to adjust policy if it turns out the data is not coming in as you expect, consistent with your forecast.
How do you even trust the data when it's so far behind at this point, and a lot of questions about how accurate some of the data is?
Well, the Fed does an excellent job through its reserve banks of collecting really real-time information from businesses, from labor market representatives, right, from consumers and community representatives, and they do their own surveys. So there's a lot of really good, I think, information out there. And it's a mass amalgam of all that data and all that information that informs your outlook for the economy and informs monetary policy.